So now we're being recorded. So that way, everything I'm talking about from now on for the rest of tonight will be recorded. And that way, anything that I illustrate or talk about with chapter 2, you should have access to it literally for the whole semester. Okay. So a couple of things. I'm not going to go through every single slide because you do have this illustrated for you already in Blackboard. You can go and play my video. But tonight we're going to get into what they call analyzing transactions and this thing called the fundamental accounting equation. And this is literally, I'll just get right to the equation right here. This is really the foundation of all the accounting when we get to the financial statements. And I don't want you to lose track of the financial statements because that is where we're headed. But you'll notice we have assets is, of course, I'll talk about the definition in a minute. Assets is on what they call the left part of the equation. Assets equals liabilities plus owner's equity. Okay, so we'll talk about what each of these means, and what you're going to have to be able to do in chapter 2 is to be able to recognize the different types of asset categories that a business might have. And remember, we talked last week about the different types of business entities, whether it's a proprietorship, partnership, or corporation, all that applies. But we'll work on what they call classifying asset accounts like cash, equipment, stuff like that. We'll look at how you classify liabilities. And the big one that you're going to find is accounts payable. I'll show you where that is when we get to it. And then we'll talk about in a minute, what does equity mean? And some of you may already have some pre-knowledge about what you think equity is, but accounting has the definition. I'll show you how you define it within the framework of the equation. So since I've got this slide up, and I think it's easier for me just to kind of annotate on it, I'm going to write over this. I'm going to go over to this concept of the asset. And I'll start with the asset first. And the thing I always do when I'm on campus or in the classroom, we always say the first thing we start with is define an asset. And the first thing I'm just going to give you is just think of assets are things that you own. Okay, keeping it real simple. I mean, the technical definition, if you really want to look it up and get into it, it's got some sort of economic benefit to a company. Potential future economic benefit is the key words that the accounting rule makers like to use. But just to kind of break it down, essentially, assets are what you own, all right? And we'll get to the financial statements today, but I'll show you the different categories and kinds of assets that we have. Cash will be the most common one you see. Equipment, you'll have supplies, you'll have something called prepaid rent. I'm going to write this one right here, prepaid rent. And you might be thinking, what does that mean? We'll get to that. But after this chapter, you'll become familiar with the language of accounting, because remember, accounting has its own language. It's different than if you're taking like a physics class. All right, so we'll talk about how the accounting people write, and that's what we're going to be practicing in chapter 2. And again, you're going to find that the math is really easy. If you look at this equation, you take your assets, you make sure that they're equal to your liabilities and your equity. It's just, for the most part, for the first few chapters, we're just adding and subtracting. So it's not math issues in accounting. It's more about knowing the rules. All right, so if we say that assets are what you own, we're going to say that liabilities are what you owe, okay? And I think everybody probably understands the concept of something that you owe, like credit card debt. You might have a car payment, a loan on a car. You might have a mortgage, okay? That, businesses have debt, okay? Businesses have assets. And so what the accounting rule makers did is they specifically defined what assets are, which are basically, things that you own, property that you own. They specifically defined what liabilities are, which are essentially your obligations. They like to say obligations, things that you owe. So then what they did was they left the equity kind of like, they didn't define it specifically, but once you define 2 of the 3, they basically said equity is going to be what's left over. So what you can do is you can take this equation. So if you've got your assets, you can take your assets and subtract out your liabilities. So all I'm doing is I'm going to rewrite this equation by moving the liabilities to the left side of the equation. If I do that, that's going to equal your equity. So if you take your assets and subtract out your liabilities, equity is literally what's left over. It's what's remaining. And if you think about this, hopefully it's positive, right? You typically want to have positive equity. In other words, you want to have more assets than you have debt. You want to own more than you owe, okay? And if that resonates with anybody, I mean, you can look at it even from the concept of a house. So if you own a house, but you have some debt on it, if you have a mortgage on it, then you don't have 100% equity. The bank or the lender also owns it. In fact, they probably have the title to it before you can actually get full ownership. But what happens is over time, you pay down that debt and your equity is going to be increasing. If you've ever heard of the concept of somebody's net worth, that's where this concept comes from. If you have net worth is where you take all of your assets, subtract all of your debt, and what's left over is essentially what you're worth. That's called your equity. And that's how the accounting looks at it when you're looking at a business entity, whether it's a corporation.
So if you're on a Pell Grant, I don't think you can do it that way.
Yeah, I'm paying out of pocket.
Back. Can you guys hear me now?
No, I got to pay out of
Yeah.
pocket.
Yeah, I can hear you.
I apologize. My internet went off. Like I said, I hope it didn't happen. If it happens again, just hang on there, my internet. So hopefully, can everybody still hear me?
Yes.
Yes.
I apologize. Let me get back to my screen. It may have actually, everything I wrote is probably gone, but that's okay. All right, can you guys see it again? I'm on the,
Yeah.
Okay.
Yeah.
All right, so and let me make sure I'm recording. It happened earlier today once, and let me make sure. Okay, it's still recording. All right, cool. So this real quick to recap, and then I'll move on to the next concept. So just remember that again, with your assets, if you're trying to define equity, you can take your assets, subtract out your liabilities, and equity, I'll just use the term equity, that's said to be the residual, or essentially what that means is that's what's left, okay? And hopefully it's positive. And you could get negative equity, that happens. In fact, that's happening quite often too much these days. If you have negative equity, that most likely means you're going bankrupt. And you know, you've seen a lot of businesses in this crazy times with this COVID where they just can't stay open because they either have too much debt or too much expenses. They don't have enough cash. And let's talk about cash. They don't have enough cash to pay their bills. They can't stay open. And so what happens is they just have to close the doors. So, and the accounting books, the accounting rules basically can record everything and helps you keep track of all this. If you're running a business, hopefully you kind of, you know, understand how to read your financial statements, how everything's put together. It'll also help you make better decisions. Okay, so again, assets, again, what you own, liabilities, what you owe, and then of course, your equity is the differences when you take your assets and subtract out your liabilities. That's how the accounting rule makers set it up. They specifically define 2 of the 3, and they just let equity fall out. All right, now, so let me clear that. All right, so what we're going to do with this then is we are going to analyze some transactions. We're going to use this equation to go through several transactions, and we're going to say what's an asset, is it going to be increasing or decreasing, and what's a liability, is it increasing, decreasing, and so forth. But just remember that this equation always has to balance. It always has to be equal. You can never have one side that's greater than the other. They're always balanced. So that's one nice thing about accounting, is it forces you to balance, okay? Now, before we get to the financial statements, one more thing I want to show you here is I just mentioned the concept of a business transaction. Well, there are actually 4 types of transactions we're going to be looking at, and I call these equity transactions. And in this framework, and let me just go through each one of these, you'll notice we have revenue, expenses, investments, and withdrawals. There's 4 different categories. You got to know these. Revenues is your inflows of money, right? Just like how does Walmart earn money? They sell merchandise. How does McDonald's earn money? They sell food. So I think you understand the concept of revenue. That's pretty easy. Inflows of cash. Revenue will increase equity. Every time we come up with a revenue transaction, that's going to increase equity. Your expenses, that's going to be outflows of cash. That's when a business has to pay their bills. You pay salaries, you pay rent, you pay utilities. Notice that's going to decrease equity. The third category is called investments. That's simply when you're investing in your business. you're either, if it's a corporation, it would be a stock, a company sells stock. If it's a proprietorship, it's simply where the owner is putting money into the business or property. Notice those also increase equity. And then the last one category is called a withdrawal. Later on, we're going to call these dividends. Well, when you get, if you take financial accounting, they're going to call it dividends. We're going to use an account called drawing, but it's going to fall under this category of withdrawals. And that's simply going to be, like, most of the time it's where the owner takes something out of the business. If you own your business, if it's a sole proprietorship, sure, you can take the cash out. But if it's for personal reasons, it's going to fall into this category called a withdrawal. Notice expenses and withdrawals both decrease equity. They act the same way. So you might be saying, okay, what does it matter? Why do we have to have two different categories? If they both decrease equity and they both represent some sort of outflow of money most of the time, why do we just call them one category called expenses? The reason is, quite honestly, the intent. Expenses is part of the normal course of the business expenses. A withdrawal would be a personal expense. Remember the separate entity assumption. Anything that's personal, you want to keep it separate from the business so it has its own different category. Now, we're going to go through some transactions in a minute. I'm going to show you a couple on the PowerPoint. And since I've already illustrated this whole PowerPoint for you, I'm not going to do every one of them, but just to kind of start you off tonight, I'll give you a couple live comments on it. And then at that point, we will get into some of the textbook problems. I'll pull up the e-text and we'll start working some problems. Now, the last thing I want to say on this is, remember, our goal is, let me go back, is to use this equation to analyze transactions. But the goal is remember the part of accounting where you're classifying, you're summarizing, and you're reporting financial information. We want to get to these financial statements. So I'm going to get to the end of the PowerPoint real quick, and I want to show you the financial statements. Now, this is the last two, these are the last two slides in the whole thing. And I just want to illustrate this to start with, is that there's actually an order in which you have to prepare these financial statements. And I'll show you the relationship in a minute. But the order goes like this. You want to start with your income statement. That's the first. Then you go to the equity statement. And then you go to the balance sheet. So hold on, I got a question. Jay, you got a question? I can stop for a minute. Jay. Go ahead.
So your PowerPoint is different than the one that we have from Blackboard.
Yeah, it's a little bit different. This is the one that I've illustrated. This is the video one I've illustrated in Blackboard.
Okay, because I was going through it because there was like page 11 essentially on your PowerPoint. I was just writing down just quick tidbits of like the 4 types of equity transactions to study on.
Right, right.
But I'm bad at keeping up, and so I was looking at my PowerPoint and I'm like, that is not the same.
Yeah, it's a little bit different. What happens is I've used this PowerPoint probably for about, I want to say 5 or 6 years. This stuff is static. It never changes. But what happens is this semester, it's a new textbook edition. So the new PowerPoints that I gave you guys would be different. And I gave those for note-taking purposes. I'm not trying to confuse anybody, but it's the same stuff. Nothing's going to change. It's the same content. I've used this old PowerPoint for such a long time. So as you go back and do some of your reading, you'll find that what I'm telling you is essentially the same thing that's on there. So, but yeah, so don't
like
get
the format of how it was written out, and so that's why I was just going to write it that way.
Well, you can do either way. I mean, even after tonight, you can always go back and review it and take some notes. But I think you're going to find, either way, and I'm not trying to act like it's not a big deal, but it's really not a big deal. And I'm saying that quite honestly, because once we start to practice these problems, we'll get to the textbook problems in a moment. That's how you're going to learn this stuff. It's not just reading and note taking, which are very important, by the way. You're going to find that when we start to practice these problems tonight, it'll all fall out. You'll see it. All right, so we've got the income statement number 1, the equity statement number 2, the balance sheet is going to be the 3rd financial statement. So 1, 2, 3. That's the order we're going to prepare these. So does somebody have a question?
Sure.
Okay, nobody. All right. So on the last slide, let me get to the last one. You'll notice Here's the relationship they're trying to show you, and then I'll go back and I'll show you a couple things. You'll notice that the top one is your income statement. Notice there's a time period on here that says month ended. And then I want you to see what's on the income statement is revenues and expenses. So your income statement literally summarizes revenues and expenses. And once you go back and study, remember revenues and expenses are two categories of equity transactions. Your income statement is a financial statement that says if you take your revenues, subtract out your expenses, you get net income or net loss. Hopefully, if you have more revenue than expenses, you'll have a net income. If you have more expenses than revenue, then of course you'd have a net loss. But notice the first financial statement, you got net income. And then the second financial statement, which is your equity, notice it's got the title of the financial statement. And look at the time period. There's always going to be a date or a time period on these financial statements. So month ended, that's for the month ended December. But do you see how they're transferring that net income over to the equity statement? So what happens is your equity statement adds your net income into its own statement. Notice the formula. You have a beginning capital number, you add net income, and then you subtract out any withdrawals. In this case, there were some withdrawals. And then at the end, you're going to get an updated capital balance. So what's going to happen is, this is financial statement number 2. This balance then gets transferred to the balance sheet as the one balance for equity. Okay, so your equity account on your balance sheet is literally summarizing all of those equity transactions, revenues, expenses, investments, and withdrawals. They didn't have any investments on this one, but sometimes you do. But look at the format. Income gets transferred to equity. Equity gets updated, and summarizing all your information, and then it's going to transfer that to the balance sheet. So at the end of the day, that's kind of where we want to be. And right now, we're just going to getting a little bit familiar. You start to look at these financial statements. So you're saying, what am I looking at? This is where you're going to start doing some reading and some studying. We'll get to there today a little bit. But we're going to be preparing an income statement today. We're going to do an equity statement, and we're going to do a balance sheet. But before we can do these, we're going to go through that accounting equation and do the analysis. We're going to go through some transactions. We're going to show you how an accounting system would record transactions. It's going to summarize those, and then eventually we'll get to these financial statements. So keep in mind, everything that we're doing, most of it is automated these days, all right? In fact, with technology, a lot of it is so fast. It doesn't mean, though, that you don't need to not know it. You have to know it. You still have to understand how the system works. You have to understand how the equation works. So even though the concept of just recording an increase or decrease may be done by a computer, you still have to understand it because there's always mistakes. At some point in time, there's always going to be some sort of human input error, and you have to sometimes go in and fix it. Okay, so question.
Yeah. Can you do the actual math of the first equation, the 47,000? Like, I'm not understanding how you got, I can't even see it no more.
Can you see my slide?
No, it says something about done speaking. Hold on.
Can anybody else not see it? Did it fall off?
Yeah. Wait, no, it's back on. Okay, so, okay, I'm just trying to figure out how you got that large number on your net income. You did 47,000 minus what? Can you do the math on that?
Yeah. All you do is take 47,000 and subtract 8,650.
Okay. And that's the revenue minus what?
Expenses.
Okay, both of the expenses, salaries and utilities. Okay.
Mm-hmm. Yep. Think of these financial statements. These are summaries of what's already been recorded. This is just the summary effect of where now you're reporting about what happened. Okay. And
Okay.
I'm just showing you guys this right now, and we're going to go back and do this, but I just want to give you a heads up. This is where we're headed. We're going to go back through that accounting equation, and we'll show you how they came up with this revenue. We'll show you where these expenses came from. But just for now, you guys all need to understand, if I were to say, and this could be like a quiz question or even like an exam question, you could say, well, what goes on the income statement? What gets reported on the income statement? And you should know that the income statement reports revenues and expenses only. It doesn't report anything else, okay? The equity statement takes that income from the income statement and pulls it over. Your equity statement also accounts for withdrawals and if there were any investments. And then, of course, your balance sheet is your accounting equation, because look at it. You've got assets, liabilities, and then there's your equity. Notice it's kind of small, but it says your assets are 136,850, and your liabilities plus your capital is the same number. So your balance sheet is essentially going to be your detailed, or I'm sorry, you could say it's your detailed accounting equation, which we're going to do that tonight. And another thing about the balance sheet, I don't think I said it earlier, look at the date. It's got one date, one specific point in time, where the other ones typically say for a period of time. So income statement, equity statement might say for the month. The balance sheet is just going to say at the end of the month. So that's kind of important, because if you think about it, that cash balance, if you're on December 30th versus December 31st, that cash balance could change every day. In fact, if you go to January 1 of the next year, you know that cash number is going to be changing with the way businesses, you're paying everything electronically anyway. So this December 31st is the one financial statement that says one point in time. Now, to go back, let me go back now. So I'm going to go back to the start of these transactions. So just remember, again, that a business transaction, let me get to it. All right. They give you the first one, and in your business transactions, I'm going to go through a couple of these, and then we'll get to the book. But essentially, we're going to try to look at how they affect the accounting equation. And keep in mind, it's typically in looking at all these transactions, they should all fall into one of these categories. It's either going to be a revenue item, an expense item. It's going to either be an investment or a withdrawal. So just to kind of keep it simple, there's 4 different types of transactions we're going to be looking at. Now, this first one says Eli withdrew $100,000. Let me erase that drawing. $100,000 from personal savings and deposited into a new checking account under Eli's consulting services. So this would be an example of an investment where you're starting up a business. And remember the separate entity assumption where you keep your personal records separate from the business. Your business has its own records. So if you took $100,000 theoretically and wrote it to your own business and started a new bank account, how would it look like in the accounting equation? So what's going to happen is it'll go something like this. I'm going to try to annotate this a little bit. So notice we've got cash, which is an asset. And then, of course, because this is an investment, they like to use this capital account, Trayton Eli Capital. That's going to be the account name we use for investments. That's going to be on the equity side of the equation. So notice the equation always has to balance. So we're plus 100,000 cash, that's an asset, and you're going to say plus 100,000 in the capital. So every time we have a transaction, there's going to be at least 2, guys, at least 2 items are always going to be affected under this equation, because you have to balance. Okay, now, so if you did that, so every time you have an investment of cash in the business, you'll increase cash, which is an asset, and you're going to increase capital, which is an investment. So we don't say the word investment as the account. They like to use the capital account. That's what they use. So it's just a thing you're going to have to get used to as you start to read accounting problems. Now, look at the next one. So under the next one, you'll notice that it says the company buys equipment for $5,000 cash. And keep in mind, equipment and cash are both assets. So I'm going to go ahead and write asset up here. And of course, here is your capital account. But in this situation, the only 2 items that are affected essentially are 2 assets. And notice what they did. They decreased cash as a minus by 5,000, and then you're going to put a plus 5,000 under equipment. So they literally took whatever cash they had, part of the cash, and converted it into equipment. And the accounting records would show that. So you're decreasing one asset, and you're increasing another asset. Notice, just to keep this simple example, your total assets are still 100,000, right? and your total capital is still 100,000. So your balance, your accounting equation is still balanced. It's just that your accounting deals with all these details. You have to show that cash went down by 5,000 and that equipment went up by 5,000. Okay, so that's the kind of thing we're going to be looking at in this chapter. Is when we see some of these transactions, you got to know where they go. You have to know, are these assets, are these liabilities, and so forth. And that's, of course, what we're going to be practicing tonight. Okay. All right. So that's, let me do one more, and then we'll get into, I'll do a couple more, and then we'll get into the textbook. Looking at my time. All right. All right. Look at this one. So on this one, we've got, it says the company buys $6,000 of equipment on account or on credit. So that might be different when you're reading this. I mean, everybody can read it, but you might say, what does that mean? So if you buy something on account, it basically means you're not paying cash for it. You're essentially it's like a short-term loan. So notice what happens is they're going to increase equipment. Again, let me just remind you, I don't know why they didn't title these this way, but again, these are your assets. But look at what they did. They increased equipment by 6,000, and they increased this thing called accounts payable by 6,000. Guys, accounts payable is going to be your most common liability you're going to see this whole semester. All right. Now there's another account called accounts receivable, which everybody always gets backward. Not everybody, people get confused with that. But accounts payable, anytime you see payable, that's going to be the liability. So in this case, you bought the equipment for 6, and then you also increase your debt by 6. Notice your equation is still balanced. 95 plus 11, we're adding all your equipment. 95 plus 11 gives you 106, and your total liabilities, which is 6 plus your capital, is 106. Notice you're still in balance. So every time you look at any sort of record, increase or decrease, this equation always has to be in balance. And that's the nice thing about accounting. Now, it doesn't mean that you couldn't still make mistakes. You could always use wrong account names, and that happens a lot. But for now, yeah, the nice thing is you're a little more confident when you're doing these, you should always be in balance. Now, look at the next one. So the next one, notice we've got purchase supplies for cash for $1,500. So notice supplies, and again, I'll give you the heading again just to kind of remind you on this. These are all assets right here. They say property, but just write assets. Every one of these are assets. So you're increasing supplies by what, 1,500? And how you pay for them? In this case, you paid for them with cash. Notice you decreased the cash by 1,500. So you bought supplies and you decreased cash. And of course, notice you're still balanced. The total assets didn't change, and your total liabilities and equity did not change either. Okay. Now, one more I want to get to this. The next one, I'm going to show you what happens when you make a payment. So on this one, I'm sorry, let me go back. Jay, I'm sorry, I'll stop. Question. Jay, I said you had your hand up? No?
No,
You're good?
Can I lower my hand?
No, you're fine. Yeah, I'm sorry. I want to make sure I do not miss anybody. Sometimes I got a couple different screens up. So sometimes if somebody has a chat or if somebody raises their hand, no problem. I don't want to miss anybody. And if I'm going too fast and you want me to go back over something, just please let me know. All right. So, all right. So again, look at what they did here. So again, the firm makes a payment of $2,500 on account. Now, if you took an English professor and analyzed the way they wrote this sentence, they would pick it apart. They'd say, this thing is written so weird, it doesn't make any sense. And when you start to look at it, it's really weird. What does that mean? The firm makes a payment of $2,500 on account. All that means is you're paying some of your accounts payable. All right. So look at what they do. They reduce accounts payable by $2,500, see the minus, and they reduce cash by $2,500. All right. So you make a payment, you're paying some of your liabilities, you reduce cash, and you're reducing your accounts payable. Notice, once they've updated all these accounts, your equation still balances. So you'll have some of that. Anytime you make a payment and you're paying some of your accounts payable, you simply reduce accounts payable and you reduce cash. Sometimes when you get to the textbook, they like to use the word you sent a check, issued a check. Remember, check and cash literally is the same. And I think everything here is really theoretical if you think about it, because quite honestly, businesses don't use a lot of cash anymore. I think we're just trying to teach the concept of cash. I mean, cash is really just a number in your bank account, because quite honestly, just about everything these days is paid digitally, paid online, but it's just the idea of what cash represents. Okay. All
Okay,
right.
so when it says the firm, that makes me think like somebody else is making a payment to the account. It doesn't make me think as if my business is making a payment on an account.
Yeah, it's just gotta get, yeah. So basically it is. It's the company, the business, however they worded it, but the business is making a payment. So whoever is in accounts payable, who was ever the treasurer at the company, they're actually, you know, if you can just visualize somebody writing a check, or there's a computer program that's been programmed to pay certain bills on certain dates, but this is literally the company that's paying its debt. That's what they mean by that.
Okay.
So here's the deal. This is a good question. So look, when we start to read this stuff, yeah, you got to get used to how they write these things out. And they don't always make sense, but here's what you'll see. Once we get through, let's say, chapter 2, you'll find that several of the transactions, in fact, most of the transactions to the rest of the book are worded very similar. So it's really kind of just, okay, let's practice reading these problems. And then once you practice it and you get used to the language, it'll make more sense. And I remember when I was an accounting student back in the day, that's probably what confused me the most, because it was never the math. You know, math is universal, but the math in accounting is really some of the easiest. It's the basic math, right? And people always confuse it when they see an accountant and like, wow, you must be really good in math. And not necessarily. I mean, accountants probably are decent in math, but it doesn't mean you have to be really good, because remember, computers do all the math for you anyway. You just have to know the rules. You have to know what gets increased and what gets decreased. But that was probably the biggest deal back when I was a student and going through a lot of the accounting courses. It's where some of my classmates and me, and of course, I'd always get confused too. It's most of the time it's how something was worded. And that's where it kind of got down to back in the day, well, they're just being tricky. They're trying to trick you. These are trick questions and so forth. And I would say it's not really a trick question. You just have to read it very carefully. And the thing about accounting is sometimes one word can change the whole concept or the context of a question. All right. And later on, when we get to some review and some study, I'll show you what I mean by that. But yeah, you got to watch the words very carefully in accounting. All right. Now, so let me see if there's any other slides I want to go through. Let me show you one on revenue real quick. So on this one, it says the company, notice they don't use the word the firm. They say the company performs services on account. Let me erase my drawing so that doesn't confuse anybody. So what does that mean? So most of these initial problems that we look at in the first few chapters, it's most of the businesses are consulting or service type of businesses. So to earn your revenue, they're going to say perform a service, whatever that. It could be a tax person. You're performing taxes. You could be a dentist. You're performing a service. Well, perform service means revenue. And there's going to be two types of revenue. There's going to be what they call cash revenue and then credit revenue. This is credit revenue, meaning we didn't get paid. We earned it, but we haven't been paid yet. Look at the equation. Notice we've got revenue of $11,000 is under this revenue category. And then they're putting that $11,000 on the asset side. They're putting into this account called accounts receivable. Accounts receivable, notice that's different than accounts payable. Accounts receivable means we're expecting money to come in. So later on, whoever owes us money will hopefully pay us. And you might be saying, well, isn't that risky? Well, that's part of credit. You know, there's always risk in business. Typically, you can grow your business faster by not having everybody pay up front. Usually, if you give a customer 30 days to pay, they'll come up with it. That's going to help you grow your business. And later on, we'll deal with what happens when a customer does not pay. But that's not till more towards the end of the semester. But for now, accounts receivable would be if you perform services on account. That's what they mean by that. So notice this goes under accounts receivable. There's plus 11, and then your revenue goes plus 11 because this is an equity. All right. Is there a question on that one?
The company, who is the company?
That's not real. Yeah, it's whoever the company is.
Okay, so it's not my capital business?
It's whatever company is in the problem. It's in whatever the context of the problem. You know, I think this company is Eli Consulting. I think if you go back and look at the problem, I think all these transactions are from this individual person, I think. But
Okay.
whatever company it is, yeah, that's not really the most important. The thing is that this is how any business or entity records their information.
So the company is always basically the capital?
I'm sorry, say that again.
So the company is basically always the capital, the
Well,
owner's equity?
the company is the entity you're reporting on.
Okay. I'm confused.
So the company, all we're doing here is we're going through transactions of this is what would happen within a business. This is how a business or a company is going to, this is how they're going to analyze and report their transactions. And this one, this particular transaction on this one is simply where a business is earning revenue and you're putting it under the accounting equation. You're putting it under the revenue right here. And then remember the equation always has to balance. And so revenue, it's either going to be cash or accounts receivable. Well, if this was cash revenue, it would say you performed it for cash, but it didn't. It said performed it on account. So this 11,000 goes under accounts receivable. Eventually, this 11,000 will get transferred over to cash when we collect it. Okay, that'll be a separate transaction. Okay. All right. Now, in fact, even on the next one, let me go to the next one. Last one, and then we'll get to the. If you look at the next one, notice this one says collection of $6,000 from customers on account. This one just says you're collecting some of your accounts receivable. Notice you're decreasing accounts receivable and you're increasing cash. This is what a business wants. You want that money. You don't want to have too much accounts receivable for too long because that's risk. That means you have people who owe you money. If you don't pay it, in fact, cash flow is very important for most businesses. If you don't have that cash flow coming in, you're going to be in problem. You can't make payroll, you can't pay your bills. So the goal is to make sure that this accounts receivable gets turned over into cash, just so you know. This just simply says collecting 6,000, you decrease accounts receivable, and you increase cash. Okay.
Okay.
All right. Any more I want to look at? Oh, here's one where there was a withdrawal.
Oh, so
no question. Let me go back. Question.
Oh yeah, just a quick clarification. So accounts receivables are always assets and account payables are always liabilities?
Yes, always.
Okay, that's all I needed.
And in fact, accounts payable, I think, you know, for this class, you'll in upcoming chapters, the different liability accounts you're going to see, you'll have accounts payable. You might have salaries payable. You might have wages payable. Sometimes you use the word wages. You might have Social Security taxes payable. But as long as you see that word payable, it's going to be a liability. Accounts receivable, that's the only one. Now, we will get into, I think it's in chapter 12, we'll get into something called a notes receivable. And when we get there, the only difference between accounts receivable and a note receivable is the concept of interest. Because usually with interest, you charge interest on a loan, either way. For right now, there's no interest involved. Later on, we'll show you how to calculate the interest. All right, but look at this one. Notice how it says the owner withdrew $5,000. Notice they're going to take $5,000 out of cash. And then what they should have done is they should have created another category here and just called it withdrawals. But they just went ahead and took it out of capital. But notice it's reducing capital, right? You got minus 5,000 here and minus 5,000. And notice it does not go under expenses. A withdrawal is considered personal. It's not considered part of the business's expense, but you still have to show it being taken out of the business. So in this case, you're going to show it as a reduction to capital. Okay. And I think the previous one, I don't know why I skipped that, but the previous one was just showing you this is what would happen if you're paying your expenses. Notice you've got $650 paying for utilities expense, and notice you're taking that out of cash, and then you're also reducing your expenses. I don't want you to be confused by that plus. In fact, ignore that for now. Just remember that your expenses are negative. You're always going to be reducing equity with expenses. Okay. All right. So that's it. That's just to kind of start you off. I just want to give you a preview because again, I've got these already recorded, and you can either, you know, after tonight, you can play this whole lecture, this discussion again, or you can also play the Blackboard recording in the Chapter 2 module. But what I want to show you next is, let me get into the textbook. All right. Take a minute. All right, so what I'm looking at right now, and if you don't see this on your screen, let me know. It's exercise 2.1. Everybody got it?
Yeah.
Yes.
Again, all I'm in, this is just the e-text that you guys all have. So whenever you're in Connect, these are just the applications at the end of Chapter 2. These are not your homework problems and that you have to turn in. These again are just practice. But what this is, and what I want to do, I'm looking at the clock. It's 7:52. All right. So I've got several of these end of chapter applications and problems I want to now go through with you. I'm going to record some of these and illustrate with them with you. And I intend to do up to the accounting equation problems and also show you how to put together the financial statements tonight as well. So I'm going to start with exercise 2.1. And I just want to remind you that you actually have all of these solutions in Blackboard. Just go to Blackboard ebook solutions. You have every one of the solutions. So even after tonight, if you're saying, hey, I want to go practice some of these in the ebook and you're wondering what the correct answers are and you can't find them, just go to Blackboard, click on the ebook solutions and open up a file. You'll find chapter. It's all sorted out by chapter. Okay, so exercise 2.1. So here's what we'll do. Starting with this first one, we're just going to work on classifying these under the equation. So notice we've got just before Henderson Laboratories open, the owner had the following assets and liabilities. Determine the totals that would appear in the firm's fundamental accounting equation. Okay. All right. Now, so what we want to do here, I'm just changing my mouse. That's nothing you guys are doing. Hold on. I'm just getting something out of the way here. All right. All right. So what we want to do here is we're going to go through these and we'll start with cash. And then we're going to plug these in. So what I would do, I'm going to write this up at the top of this just to illustrate. So I would say, okay, we've got assets equals our liabilities plus our equity, owner's equity. And so what we want to do here is we want to say, can we figure out our total assets and our total liabilities and our total equity? So I'll start with cash. So hopefully you know that cash is an asset. That's probably the first one we all learn. All right, remember, that's something that you own. Think of an asset as it has some sort of benefit to the company to help you earn money. Look at the next one, laboratory equipment. What do you guys think? Would that be an asset, a liability, or equity?
Asset.
I heard a couple people say asset. You're exactly correct. That's an asset. The next one, supplies, laboratory supplies. What do you think?
Asset.
Very good. You guys got it. Very simple. So right here, these first three right here, those are all assets. If you were to add these together, you could get your total assets. And on this one, you add these up. I'm going to write this up here. That's going to give you I got 275.6, and you can go back and check that out. But you should get about $275,600 of total assets. Now, before I go any farther with this, right, any further, this is an accounting equation. The total assets must equal your total liabilities plus equity. So if I stopped right here, if we didn't know anything else in the problem, if I were to ask you, what should your total liabilities and equity total, you'd say, well, they should equal your total assets. So everything on the right side of the equation should equal 275.6. So hold on just a second to make sure I'm not missing out. Somebody had a question. Oh, somebody got kicked off. Yeah. Guys, if you guys, anytime, yeah, tonight, last week, I did not have any internet problems, but tonight it seems like I was on earlier today and I didn't have any issues, but this afternoon I was doing some work and I got kicked out a couple of times. So it's just, you know, it is technology. It is what it is. So, all right. But if you happen to get kicked out, just log back in and then just email me if something ever happens. All right. So on the liabilities, notice we've got loan payable.
Mm-hmm.
Remember I said earlier, oh, I got the wrong thing. Oh, hold on. All right. So loan payable, we know if you see that word payable, think liability. So we know that's a liability. And of course, you guys have seen accounts payable already. That's
Right,
all.
that's all.
So
Right,
now
that's it.
we've got, I'm sorry, are we good?
Liability.
Two liabilities. If you add those together, you get 53,150.
150.
All right. So stop right there. And here's where we got to be able to understand math a little bit. And I'm sure you guys learned math. I did a long time ago. I think you learn how to add. I think nowadays it's second grade, first or second. I have an 8-year-old, and I think they practiced their addition last year. Now he's into multiplication. So this is your basic concept, and I'm just trying to be funny here. But to get equity, notice equity we don't know. They didn't give you that. But because we know this equation has to be equal, we have to balance. Does anybody have any ideas of how we would figure out equity?
Subtract that from the asset.
Subtract the
Yep, you got it.
liabilities from the assets.
I heard somebody say subtract or do the difference. That's exactly how you do it. So if you take 275, 600, subtract out 53, 150, that is what your equity balance would be. And if you get I got 222, 450.
I was just gonna say 222, 450.
There you go. So if you take 53, 150, add 222, 450, you're going to come up with that 275.6. Okay. And that's I mean, this is just real simple, but that's essentially what the equation does. That's your accounting equation. Okay. All right. Did I need to repeat any of that to anybody? Are we okay? Okay, we're good. All right, that was 2.1. Let's go to the next one. Let me clear that. The next one is just filling in the pieces. So on the next one, notice, and these are all independent situations. We've got assets, liabilities, equity. Notice you got assets of 64.7, liabilities of 13.440, and notice the unknown is equity. They want you to simply fill in the pieces. So we just did that, didn't we, on 2.1? So we all know that you have to subtract, and once you subtract, you should get equity to be, it looks like 51,260.
Yes.
Wow.
51,260, you're good. And of course, this is where, like, you know, if I was in class, I would say, you know, go ahead and do the calculation. Don't just, you know, as I'm talking and you think you know what you're doing, go ahead and type it into your calculator. Just because what happens is just the repetition, the concept of doing it a few times. This is how you're going to learn it, not just by watching, but just do it a couple times, and that way you know how the accounting equation works. This stuff can show up in the multiple choice questions on an exam, where I could give you a list of assets, and one of the questions might be, what's equity? And you have to know how to use the equation. All right. Number 2 works the same as number 1. Notice you only have one unknown. Looks like you should get about, I got 45,040 as equity. So the first 2 are the same. Notice on number 3, the unknown was your liability. And of course, I think that's 96,150. So your liability, you're still going to subtract. You should get, I think it's 71,550. If you got that, you're good. Okay. I think number 4 is probably the easiest one to think about, because they didn't give you the assets.
In number 3, you're subtracting the owner's equity from the assets.
Correct.
To get the liability.
Yep. So you take 96,150, subtract out the 24,6 right there. And that's where they would have gotten that. Okay.
Okay.
If you look at number 4, notice they add the liabilities plus the equity, And then that would just give you 79.
Hold on, slow down.
Was there a question?
Okay, I'll just ask you to slow down.
Okay. So if you look at if you go back on number 5 and look at number 3 and number 5, you'll notice the unknown was your liabilities. And so of course, to get that liability, you do exactly what I just did in number 3, is you have to subtract. So
Okay, so
question, yes.
So to get your equity, you would have to add the assets and the liabilities. And to get your liabilities,
I'm sorry, say that again. To get your what? To get your equity?
Yes. Okay. So to add your assets and your liability, that's the solution to your equity, right?
No. Again, here's the equation. Let me go back. So this is your equation right at the top here. And each one of these individual items gave you one of them was unknown. And all we're doing is I'm just going through each one of these, and to figure out the question mark, we are either subtracting or adding. So for example, is this at number 5? So if we know total assets are 108, notice that's the left side of the equation. That means everything on the right side of the equation must also be the same, right? So we know part of that. We know part of the right side, which is the equity. What we don't know is the liabilities. So to get this unknown, you just subtract. You just take the 108 and you're going to subtract out the 58,400. Okay. And that would give you 49,600. And that's this, in other words, it's the process of how to use the equation is what we're doing here. So when you said, how do you figure out equity or how do you figure out any of these? It depends on what's given in the problem. They have to always give you enough information to plug in to be able to find that missing element. And that's what exercise 2.2 does, is they give you pieces of the equation and they simply ask you, find the unknown, okay? So the way I went through this, sometimes we subtracted and sometimes we added, but then, as I'm now talking about, just remember within the context, now that we say we are number 5, if our total assets are 108, and now we know that our liabilities are 49.6 and equity is 58.4, if you take 49.6 and add 58.4, what do you think that should give you? Well, that'll give you
Assets.
All right, does that make sense?
Yeah.
Okay. And again, it just takes a little bit of practice, and that's why I'm just practicing and I'm trying to explain. And again, the nice thing, I told my spring class, because when we went to this virtual setting, I did this with like after spring break with my spring class. I had a managerial and applied, and I spoke to them about this. The one thing that I thought was pretty cool about this live virtual lecture is that as long as I illustrated and annotated online, and I recorded, you can always go back and review this again. So lots of times if you're writing something down and you feel like you just missed it, and we keep moving farther ahead tonight and so forth, don't panic, because just remember, this will be posted probably before midnight tonight. And anytime this week, you can go in and play this whole discussion tonight. And once it's on Blackboard, what I do is I upload it to YouTube and I link it to Blackboard. The nice thing is you can easily go backwards and forwards and fast forward pretty quickly with YouTube to get to this part of the discussion. So that's the one, I think, benefit I do like about live virtual lecture. But again, in class, you can't really replace that. But I do like the fact that you can go back and now play these discussions. And I think it'll help you with your learning. Okay, wow, so I'm at 8:05. I'm getting ready. Let me clear this out. So here's where I'm at. So this was 2.2. Let me do one more. I think that's what I want to do. Let me check. I have a template I want to get into with you tonight. Yeah, let me do one more with you real quick, and then we'll take a quick break. All right. So 2.3. On this one, it says determining the effects of transactions on the accounting equation. And they want you to say D for decrease or I for increase. And these are 10 different types of transactions. And the way I'll do this one, I'm just going to plug in the numbers. I'm actually going to write out the amounts as I go through this with you. All right, just to kind of bring out the context. It's so abstract when it's put DRI. So they did number one for us. So let me get my stylus back on. So on number one, it said paid $4,200 for utilities. And notice they put a D under asset. Well, I wish they would have just put cash because you're paying cash and you're reducing cash by $4,200. Okay. And under equity, I wish they would have put expense. That's what I would have done. And then just put a minus $4,200. And that's what we're going to do. The second part of tonight's discussion is we're going to get into this accounting equation very detailed, and we're going to go through several transactions, and we'll plug in the amounts, and I'll show you how you plug it in. I'll show you and make sure how to balance, and then eventually we'll get to the financial statements. But as I go through this one, I'm going to add the dollar amounts in there. I'm not just going to say decrease or increase. I'm going to put minus or plus. To me, I like that better. If you prefer the D or the I, let me know. All right, the second one says perform services for $21,000 on account. That's going to be accounts receivable, which is an asset. And anytime you see perform services, you need to be thinking revenue. So we would have revenue. I'm going to write that over here. And you would say plus 21,000 revenue. And you say plus 21,000 accounts receivable. That's how we're going to do it. Accounts receivable is an asset. Revenue would be an equity item. Okay. All right. And again, I'm just doing these one by one, so I'm not keeping a running total of any of these. So as I go through each one of these, I'll just erase it so that way you don't get confused about anything.
So
Copy over. All right. Question.
yeah, so perform services is what again?
Revenue.
So that means to add.
Correct. Yeah. Revenue is increase equity.
Goes under accounts receivable.
Yeah. Now, if this had said, well, since you asked, so guys, look at number 2. You see where it says perform services for $21,000 on account?
On credit, yeah.
Skip down to look at number 10. Look at how they word that one. Perform services for $15,600 cash. You see the difference? Mm-hmm. On that one, again, this is number 10. On that one, you would have cash. You'd say plus 15.6. And then you'd have revenue plus 15.6. See how it's essentially the same thing, except you have cash instead of accounts receivable. But notice they word it pretty much the same way. Perform services is going to be revenue, whether it's cash revenue or credit revenue. Okay. All right. Mm-hmm. Check out number 3. I'm going to try to get through all these and we'll take a break. I'll try to take a break in 5 minutes. So number 3 says receive $13,000 from a charge account customer. So you would have cash, which is an asset. You'd say plus 13,000. And then you're essentially collecting it from your accounts receivable. You'd say accounts receivable minus 13,000. Okay. So that would be, again, these are both under the category of assets. You're increasing one asset and you're decreasing another. If you would go and look at the solutions, they would say D and I. They would say decrease and increase your assets. And I think that might confuse people. So I like to write it out in this horizontal format. I think it's easier to kind of see what's happening. At least I hope you guys, it's easier for you. All right.
So wait a minute. Why are we subtracting from accounts receivable if somebody paid us $13,000?
Well, they're saying that essentially they already owed us. They had owed us the money. Okay.
Okay.
So what they're saying is let me make up a number. Let's say accounts receivable had $20,000 as a balance. And let's say we're collecting $13,000. That's what they're telling us here. They're telling us that we're collecting some of our accounts receivable, if not all of them. We don't know that. But essentially, there's some sort of money amount that is actually owed to us. We're just simply putting that into cash and reducing accounts receivable. Okay.
Okay.
All right. Number 4, Paid salaries, 9,000 to employees. Yeah, number 4. So on that one, and by the way, you'll notice just about every one of these affects cash. They like to use cash a lot, which I think is good. So minus 9,000 cash, right? And then when you pay your employees, that's going to be an expense. That's going to be like a salaries expense. So I'm going to put minus 9,000. The reason that I'm putting a minus for my expenses is to emphasize that you know that expenses will decrease equity. You should know that, okay? But that's all you do, decrease cash. And then by putting a minus here, that's just telling me that equity is going to be decreasing. 5, paid 16,000 to a creditor on account. So we've got cash, and then now we're going to have accounts payable. So remember, accounts payable is a liability, cash is an asset. So to pay something, it means you're reducing cash by 16.
Mm-hmm.
And then what do you guys think is going to happen to your accounts payable? Is it going to increase or decrease?
Decrease.
It's going to be decreasing. I'm going to put a minus there because you're paying your debt. Okay, so on that one, you'd say decrease cash, decrease accounts payable, which of course is decreasing your liability.
So it's coming out of both accounts or just one?
Yes, you're taking it out of cash, you're reducing cash, and you're reducing accounts payable.
Why is that though?
That's how you put,
you're paying the other person.
I'm sorry, yeah, Daniel, go ahead.
You're paying the other person that loaned you the money or loaned you the liability.
Correct. Yeah. Think of it as it's like you're paying the bank. You're paying your credit card. You know, we have to pay something. And the way you have to show this in your accounting equation is that there's always going to be 2 items that are affected. Every single time, there's always a minimum of 2 different items that have to be affected under the equation. Otherwise, it would not balance. Okay.
Okay.
All right. 6. On number 6. It says invested 180,000 in the business. That's an investment. So you'd have cash plus 180, and then we're going to use the word capital. I don't use the owner now. I just use capital. Put plus 180. So an investment is going to be increasing your equity. That's how it always works. Usually, when you start a problem, that'll typically be the first transaction you'll see. It'll say the owner invested cash to start the business. That's what a lot of the problems will start you off tonight. You'll see after the problems we're going to look at later on. All right. So that's all you do. That's number 6. 7, purchase supplies on account. So on that one, we would have supplies, which again is an asset. You'd say 53.4, I'll say plus. On account means accounts payable, which is your liability.
Decrease.
And what do you think?
Decrease.
No, that'll be increase.
Increase.
Increase. And the reason that's increase is because it's like you're borrowing money. It's like a short-term loan. It's an obligation, right? We haven't actually paid for it. Usually with credit terms, you can actually receive something without paying for it up front. That's very common these days. Is it risky? Yeah. I mean,
yeah.
There's always different levels of risk. That's why typically, if you are a business, sometimes you have different credit rules for different suppliers, for different customers. If you've had a repeated customer who doesn't pay you on time, you might change the rules for that particular customer to say they got to pay cash up front. But as long as you have a repeated good credit history of a lot of your customers, lots of times, you know, you'll give them 30 days to pay. Or in fact, if you are buying something and you got good credit, the company will give you 30 days to pay. Usually it's 30. And then you just put it under accounts payable. And then eventually you'll pay that 53.4. When you pay that 53.4, you'll reduce cash and then reduce accounts payable.
Right. Okay.
All right, 2 more. 8 says purchased equipment for cash. So we've got cash, we've got equipment, and I think we've already seen this even from the PowerPoint, but let's do it again. So you're going to increase equipment, 42,000, and you're going to decrease cash 42. This is, again, you increase one asset and you decrease another. That's all you're doing.
Okay,
Last, the very last one, and then I promise it's 8:16, so it's a good time to take a quick break. But last one is a little weird, but it says paid $12,000 for rent in advance. So we're going to use an account called Prepaid Rent. So a lot of people say, wait a minute, shouldn't that be rent expense? Not yet. Right now, you pay it before you use it. So this is actually considered an asset. Anytime you see that word prepaid in this class, that's going to represent an asset. So you'd say 12,000 prepaid rent, and then of course cash would be minus 12,000. Okay, you're going to find that when we get to the concept of expenses later on in accounting, it's all about time. It's all about periods and looking at the concept of the time period. Okay. All right, so I'm going to stop on 2.3. It's 8:17.
I'm sorry, I got one more.
Okay, go ahead. Question.
Okay, so when it comes to, like you said, anything that's prepaid is considered an asset. Is that because you already paid for it? The service or anything, it's already something that you acquired. Is that right? Like you already paid your rent?
Think of it like this. Typically, if you have an apartment, your rent is due at the beginning of the month. If you're a business, you got to pay your lease at the beginning. And by paying it at the beginning, the reason it's an asset, it's the benefit is you are allowed to stay there. That's the benefit. I'm allowed to occupy that space. That's why that's called an asset. It does not become an expense until after you've used it. So not that I want to get into this discussion just yet, but guys, eventually this prepaid rent, eventually this will become an expense. And we'll deal with that concept later on, not yet, but eventually what we're going to do is we're going to do what they call an adjustment, where once we've used up that rent, we have to convert that into an expense. And we will cover that concept in chapter 5, believe it or not. It's not until chapter 5, but for now, you still need to know where it goes. For now, we're going to put that under this category called prepaid rent, which is an asset. Okay. Guys, let's do this. It's 8:18. Let's take a quick break. I'll stop the recording. I'll put I'll take a restroom break, get something to drink, and I'll try to start right back up right at 8:30. And we're going to be looking at, I think it's exercise 2.5. I believe that's what we'll look at. So again, I'll take a break. I'm going to pause the recording for a minute. You guys take a quick break, stretch, and I'll try to start right at 8:30. All righty?
Okay.
All right.